This presentation will seek to provide information around the basis for determining a company's eligible R&D tax offset. It has been based on several ATO guidance publications which are available on the ATO website. The current R&D tax incentive has been in place since the year ended 30 June 2012 and superseded the previous R&D tax concession which operated for many years. The R&D tax incentive program is duly administered by two governing agencies: AusIndustry, who assesses whether the R&D activities registered meet the legislative definition, and the ATO, who assess tax structural issues and substantiation of R&D expenditure claimed. The aim of the program is to encourage businesses, particularly small companies, to conduct R&D activities that they may not otherwise have conducted. A business must generally be constructed as a company to claim the R&D tax incentive. The definition of an eligible R&D entity is a corporation that is incorporated under Australian law or incorporated under a foreign law but an Australian resident for income tax purposes. Foreign resident corporations may also qualify where they are carrying on a business in Australia through a permanent establishment. The following entities are not able to register R&D activities: an individual sole trader, a partnership, a tax-exempt entity, or a business operating through a trust. It is also worth noting that for tax consolidated groups, the head entity registered all activities on behalf of members of the group. Once it is established that activity is being conducted by an eligible entity, the rate of the R&D tax offset and whether it is refundable as cash depends on the R&D entity's aggregated turnover. Companies with an aggregated turnover less than 20 million receive a 43.5% refundable tax offset. This provides a 43.5% refund up to the volume of tax losses the entity has, or a 16-cent permanent tax benefit where there is no tax losses. Companies with an aggregated turnover greater than 20 mil receive a 38.5% non-refundable tax offset. This provides a 11-cent or 8.5% tax benefit depending on the company general tax rate. If entities claiming under the non-refundable R&D tax offset are in tax loss, their R&D tax benefit for the year is carried forward to future years. When assessing group turnover, an R&D entity must include entities that are deemed to be connected or affiliated. Entities are connected where there is 40% common ownership. Entities are affiliated when they are acting in concert with each other or in accordance with each other's wishes. Aggregated turnover is the sum of the annual turnover for the R&D entity itself, plus any entity connected with the R&D entity, plus any entity affiliated with the R&D entity. Some important things to note in terms of the scope of transactions included within the group turnover calculations are: foreign turnover is included and should be converted to Australian dollars. Passive income is usually excluded, such as interest and dividends. Intra-group transactions between group entities are excluded. The R&D tax offset operates whereby a company claiming notional deductions for R&D expenditure foregoes a general deduction for R&D expenditure, and instead claims R&D tax offset determined by the aggregated turnover. The net impact on a company tax position during the year is a function of the R&D expenditure amount, the aggregated turnover and rate of R&D tax offset, the company tax rate, and the general tax position, including any accumulated tax losses. The permanent tax benefit of a company's R&D claim is simply the difference between the company's R&D tax rate and the general company tax rate applied against notional deductions foregone and added back. This table shows the mechanics of the R&D tax offset and permanent tax benefits. This table is based on different scenarios of the current R&D tax offset and company tax rates. Once the R&D tax offset rate is determined, eligible R&D expenditure a company may claim includes contract expenditure incurred to an RSP entity or other parties for undertaking R&D activities, salary expenditure for personnel engaged by the company undertaking R&D activities, other R&D expenditure including apportionment of overhead costs, feedstock input expenditure, that is, material used in R&D activity, R&D expenditure paid to an associate in the claim year, and the decline in value of R&D assets. Ineligible expenses are those without significant link to the R&D activities, particularly where they relate to general company operations or marketing expenditure. Some examples of ineligible expenses may include advertising and marketing costs, accounting costs, director fees, selling expenses. It is important to note that substantiation of the incurrence of R&D expenditure and the nexus with registered R&D activities has been a large focus for ATO compliance activity over recent years. Additional information on the requirements for record keeping, including apportionment methods, are detailed in our presentation on substantiation of R&D expenditure. We will now cover some specific applied issues. Companies should be mindful of the treatment of R&D assets and capital expenditure under the R&D tax incentive. It is important to note that just because an item is R&D in nature, or specifically for R&D purposes, it does not mean the outright cost is claimable as R&D expenditure. Expenditure on a tangible, depreciating asset is specifically not eligible under the R&D tax incentive. Tax depreciation on tangible, depreciating assets may be able to be claimed as R&D expenditure to the extent that the assets are used in R&D activities. Tax depreciation must be calculated using the depreciation asset provisions in Division 40 of the Tax Act. Concessional methods for depreciation on assets, such as low value pools or instant write-off, is not eligible for R&D expenditure. Where a company claims R&D materials that generate revenue, a feedstock adjustment arises. Division 355H operates to adjust the R&D tax incentive benefits for companies in receipt of feedstock revenue on certain feedstock inputs. A feedstock adjustment is an amount included in a company's assessable income. It applies when a company obtains an R&D tax incentive offset for feedstock expenditure incurred on R&D activities, if those activities produce either marketable products you apply to your own use. The feedstock adjustment applies to expenditure on producing goods or materials that are transformed or processed during R&D activities in producing one or more tangible products. The additional amounts to include in the company's assessable income is determined by calculating an amount of 1/3 the lesser of expenditure in acquiring or producing feedstock inputs or feedstock revenue. It is also important to note that if a company is in receipt of a government grant used to fund R&D expenditure, a specific adjustment may be required. A clawback adjustment applies if a company receives a government grant for eligible R&D expenditure and the company claims the R&D tax incentive tax offset for this eligible R&D expenditure. The grant clawback adjustment operates to include an additional income tax of 10% of the expenditure related to the grant that the company has claimed as a notional deduction under the R&D tax incentive. Companies and tax agents should also be mindful of the impact of the R&D tax incentive on the company's franking account. As a general principle, R&D claims reduce tax payments and therefore reduces capacity for companies to frank dividends. There is also franking consideration for companies receiving net R&D tax offset for companies who do not yet pay tax. Under the old R&D tax concession, no entry to the franking accounts from the receipt of a refundable tax offset was required. However, this has changed under the R&D tax incentive. Generally, a franking debit arises in a company's franking account when it receives a refund of income tax, which includes a refunded amount from a tax offset. However, special rules ensure that where a R&D tax offset refund is received, it is not immediately reduced as a result of the entity becoming liable to franking debit tax. The franking debit that usually arises when a refund of income tax is received is effectively deferred in relation to refundable tax offset amounts. Where a debit has been deferred for this reason, a franking credit will not arise as a result of the income tax or PAYG installments the R&D company pays until it recovers these deferred accumulated franking debits in the future. That concludes this presentation on determining eligible R&D tax offsets. Should you have any questions, feel free to get in touch with our office. There is also additional material available on our website, as well as the website of the ATO and Oz industry. Thank you.